Module 10 is about shareholders' equity. Shareholders' equity consists of two things, so shares and retained earnings. One type of shares we have learned are common shares. Common shares. Another type about which we are going to learn about in this module is preferred shares. Now, the preferred shares are different from common shares in two ways. The first is they have preference when it comes to dividends. So dividends preference. What this means is, let's say a company has $2, 100 outstanding preferred shares. This statement, $2, 100 preferred shares, means that when the company declares dividends, the preferred shareholders get $2 for every one preferred share that they own. And then let's also assume that the company has 100 outstanding common shares as well. And then the company declares a total of $200 in dividends. The company says, here's $200 that we are going to distribute to our shareholders. That is the full amount, $200. So what's going to happen is the preferred shareholders are going to get this full $200 because for one share, that is $2, and there's 100 preferred shares. So this full amount goes to the preferred shareholders, and nothing goes to the common shareholders. So that is one difference. The other difference is preferred shareholders have something called liquidation preference. What liquidation preference means is, let's say a company has assets worth $1,000, and then preferred shareholders invested $1,000 as well. And then common shareholders invested $2,000 into the company. And the company goes under, the company goes bankrupt. So then what happens is the company's assets will get sold, these $1,000. And then out of this $1,000, the full amount will flow to these preferred shareholders. They will get their investment back, the $1,000, and then nothing goes to these folks. They'll get nothing. Nothing goes to common shareholders. So these are the two ways that you can think of that the preferred shares are different from common shares. Now, when it comes to like which shares are better to own, there are some other pros and cons for each kind. I'm not going to go into too much detail at this moment. One thing that if we look at this previous example of the dividends preference, I think I added an extra R there. So let's say rather than the 200 bucks, the company declares $600 in dividends. So in this case, what is going to happen is the preferred shareholders are going to still get $200, so $2 per share, and then 600 minus 200 is 400. So then the $400 go to the common shareholders, and they will get $4 per common share. So now in this case, the common shareholders actually get more out of this than the preferred shareholders. So you need to keep these things in mind when doing an analysis of which type of a share is better for you.